Yeah, so not everything is broken. I think the handoff from the private to the public market is going through some disruption. Some rationalization needs to happen. Some irrational exuberance needs to be cut back a little bit. So I think that's what the problem is. I think these are good companies. I'm not talking about all of them. But the ones that we have invested in, Airbnb and Lyft, we still believe in those companies.
Right.
Airbnb is our star company in there. It checks every box. It's profitable. It's growing. Good corporate governance. Long runway ahead. So it checks every box. Airbnb is a crown jewel there. Lyft, we are still sticking to the thesis that transportation as a service is a big thing. You have to wait it out. It's not a 1 quarter, 2 quarter story. It's a 2 or 3 year story. They're going to be profitable in the 2023, according to my model. Some say 2022, but they can get there. There is a path to that.
Okay.
So let's see how they execute. So I think there are good companies. WeWork was an outlier. That's what we believe. They did not meet many requirements, and the public market has gotten aware of all these things, and they've raised the bar.
Right. But here's my question, because you guys you have people now saying the only way you can make money in some of these startups is if you were in the first or second or third funding round. You guys actually come in a little bit later on in the process. So is it your fault? I mean, who's bidding up these companies so that when they do come public and have to kind of cross this valuation gap, is it the fault of people who are involved in these earlier funding rounds? Is it the fault of the IPO process and the underwriters? I mean, what's happening that's causing such a large disconnect?
See, price discovery was never easy for IPOs. That's a huge problem. And if you have a transformational story, that's even more tougher. And that's what's happening here. Let's say Lyft the last round was 15 billion. And I think it came out at 25 billion. So that's where the disconnect is happening in the last round with the bankers and the early investors from the public side. I think the private, most of them are pretty rational. They haven't been very irrational there. So I think that's where the disconnect is, the bankers and the public investors, and to find the right price there. That's going to take some time. I think we'll learn a lot from this whole episode here with WeWork and the other ones. I think going forward, you'll see a lot of rationality.
So for my edification and for viewers who may not be familiar with the distinction between a public listing or a direct listing, taking a company, compare and contrast the two and tell me why some companies might choose that direct listing route and others going public in the traditional way.
Sure. Direct listing is not for everyone.
What is it?
Direct listing is you don't raise any money. Whoever the investors and the early the employees, they can sell at the IPO. So the company does not get any money. The early investors and the employees get some liquidity out there. So that's good in some cases. If the company doesn't need money, like Airbnb, Spotify didn't need it either, Slack didn't need it either. So they can go out and do the thing and then later on do a secondary down the road. But they need brand recognition. They need people to come in. That extra boost that you get, that publicity, that marketing that you get with the bankers and out there with the IPO, you will miss out on a direct listing. With IPO, it's not for the early stage
companies. It's a capital raising.
Capital raising. You need that. Most of the companies need that. So I know Bill Curley is talking about that. He's been a big proponent of direct listing. It's going to take a while to get there. But at this point, I think the status quo will remain. You'll have a mix of both. But not many companies at this point can do direct listing. So
you, just to put a pin on the Airbnb discussion, think that it's worth about, how much do you think it's worth?
We think it's worth $50 billion.
$50 billion. This is a company that Deirdre was reporting their latest funding round was around $31 billion. Private market valuations recently have been around $35 billion. So
right. Don't forget that 31 was in early 2017. Since then, they've made 6 acquisitions. Their experiences business is growing much faster than what we thought. So I think we factored all that in. So with all things considered, by the time they come to market, I think there's a path to $50 billion. That's what we think.
And that would be the total valuation of the company.
Enterprise value at that point.
Enterprise value at that point.
Yeah, that's our conservative.
And what would they come to market with as a percentage of that $50 billion?
They'll be valued at $50 billion, essentially, or more, depending on how the sentiment is.
They would just 100% of the shares would then be out there.
Yeah, not really. I mean, they put out certain number of shares, usually 10 to 15% of the float. So it's not all of it, but later on, and that's been a big problem with IPOs. The supply has been less, the demand has been more, and that's jacking up the prices too. So there's a lot of that dynamic going on there as well.
Be the next big test for the IPO market will be how that one goes.
Exactly. That'll be a big test, and hopefully that'll bring back people into the IPO.
Can you get me a nice place in Paris for a week?
Sure.